Welcome to Deloitte's Debrief Tax Webcast series in Asia Pacific. Our webcast today is from our Financial Services Industry series and is titled Tax Developments in Japan and South Korea. My name is Scott Olson and I'm a tax partner based in Deloitte, Korea, and I have the pleasure of hosting today's webcast. I have two speakers with me here today. Joining me from Japan, Stephen Baker and Mickey Vandre, who will speak about the tax developments in Japan, and I will speak about some tax developments in Korea. Stephen is a tax partner based in our Deloitte Japan office, and Mickey is a managing director also in Japan. You may access our bios on the left side of your screen. Before I introduce the agenda for today's webcast, I'd like to take a moment to highlight some of the features of our webcast console. First, all users are in listen-only mode. If you have any content-related questions, you can submit at any time in the question and answer box at the bottom right of the screen. We'll do the best to respond to your questions during our presentation. Second, all PC users can maximize or minimize each box at your own convenience during the webcast. You may also explore the icons at the bottom of the screen. If you want to download today's slides and related publications, please go to the Downloads and Links box. On the other hand, our mobile device users can view the slides on the screen and also answer the survey. Third, if you require any attendance record for today's event, you can download your CPE certificate by clicking on the Request CPE icon at the bottom of the webcast console. Now let me give you a quick overview of the topics we'll discuss. I won't read these point by point, but first we'll start with some of the recent developments in Japan. As you can see, 4 or 5 items, and then we will move on to some tax developments in Korea, followed by a short question and answer period, time allowing. So now let's turn to the theme of today's event and the topics that we're going to cover. As a reminder, the title of our series today is Financial Services Series, Tax Developments in Japan and South Korea. In terms of understanding these developments, it might make sense and be helpful to look back at some of the drivers of Japan and South Korea tax policies and how they've been evolving. In Japan, over the last 4 or 5 years, the focus of the annual Japanese tax reform has been driven by the policies of former Prime Minister Shinzo Abe, in particular measures reflecting his growth strategy, which together with financial stimulus and aggressive monetary policy made up the 3 arrows of his signature approach to rejuvenating the Japanese economy, commonly referred to as Abenomics. The Prime Minister has changed 2 times, however, in the last 2 years, beginning in September 2020, when Prime Minister Abe stood down for health reasons and was succeeded by Prime Minister Suga, who then in turn in October 2021 resigned, and he was replaced by Prime Minister Kishida. Policy priorities for Prime Minister Kishida's focus on the recovery of COVID, and the 2020 tax reform proposals were announced December last year, came with the stated goals of contributing to a positive cycle of growth and wealth distribution, and to the development of a new society after COVID-19. This has led to proposals to enhance tax incentives for wage increases in hope of pushing more money into the consumers' pockets, and for special transitional arrangements for electronic record keeping in connection with the drive to the digital transformation. For more information on those and other tax changes, we recommend listeners review the tax alerts available it's on the left-hand side of your screen, and consider signing up for any future tax alerts. We'll be covering the tax reform changes to the rules on withholding of income tax on certain dividends, and some of the topics that the financial service industry typically wants to understand and address in connection with the repatriation of profits. Although the changes to the dividend rules are broadly applicable, there have been some changes specifically to the financial service industry. For example, Japan has made changes to expand the deductibility of profit-linked director compensation and clarified the treatment of carried interest, and a recent directive was also issued on transfer pricing. As for South Korea, taxation policy that has been used by the outgoing President, Mr. Yoon, in his efforts to address income disparity and to drive other social goals. As of just a couple hours ago, over my shoulder actually, here in central Seoul, a new president, Mr. Yoon, was inaugurated, and he will lead Korea for the next 5 years. It's generally understood that President Yoon, a conservative, will push for business and investor favorable changes to the tax laws, including potential tax reductions, rate reductions, particularly focused on small business and real estate taxes. However, President Yoon's party does not control the National Assembly currently, and whether any significant changes will occur may largely be dependent upon the local elections, which will be held in about 3 weeks. As such, for South Korea, please stay tuned in the coming months, and we'll see what happens. So without any further ado, let's turn to Stephen. Could you please begin the conversation regarding the new transfer pricing directive and the recent tax audit environment?
Thank you, Scott. And I promise to try and keep it interesting for our financial services clients today. So on March 14th of this year, the National Tax Agency of Japan, or the NTA, as many of us call it, prepared a draft update to the Commissioner's Directive on the operation of transfer pricing, the administrative guidelines. The administrative guidelines are the basis on which examiners apply the transfer pricing law in audit and APA cases, and it provides significant guidance for multinational corporations, their transfer pricing planning, documentation, and risk management. Those guidelines do not necessarily have the force of law. They do provide a significant indication of how the Japanese tax authorities may actually analyze transfer pricing issues in case of examination. The proposed changes to the administrative guidelines clarify cost contribution arrangements in intercompany finance or money lending transactions. That guidance and are based on relevant sections of the 2022 OECD Transfer Pricing Guidelines, Chapter 10, interestingly enough, also called Transfer Pricing Aspects of Financial Transactions. The scope of the administrative guidelines was expanded to include other financial transactions, including financial guarantees and cash pooling. And it provides updates regarding debt pricing and implicit support. Today, we'll highlight a few of the key points with respect to the intercompany finance from the draft amendments. One big change is that the draft expands the guidance to apply to all corporates, regardless of whether they were involved in the third-party lending business. Previously, only those involved with third-party lending business were included. Now, unfortunately, I don't have any insights to share today regarding any expectations about how this expansion came to be. The draft also introduces the evaluation of related party credit risk. In doing so, this allows for the use of credit rating approaches and gives consideration to explicit support versus an incidental benefit. Now, as we all know, methods matter in transfer pricing. There's often a preferred method by either the taxpayer or the examining body. The draft eliminates the prior hierarchy of methods that was relied upon. The new significant emphasis is placed on the comparable uncontrolled transaction data, for example, loans, bonds, etc., for pricing intercompany financial transactions. And this has the effect of taking out any explicit reference to potential cost of funds methods that may have been used by taxpayers in the past. And also, this may look somewhat familiar to those who've been following the recent OECD activities in this area regarding money lending. Something of interest as well is that looking at bank quotes as comparables are no longer considered actual pricing information. They're really considered to be indicative when used to set intercompany pricing loan prices. We see this move from really helpful to just informative. Other countries, such as the US, have already moved to not giving quotes the status of pricing information, and other countries are following suit, including Japan. Authorities want to see completed transactions only.
Interesting. Some of these changes seem to be pretty significant. Is that correct?
I think the impact will vary by company, but companies are looking at their documentation and support and evaluating how they will adapt. While we're at it, let me share a few more changes with you. Transfer pricing analytics will now have to consider if funding entities actually have the capacity to do the funding for which they're pricing. Additionally, the guidelines question if the companies actually do make financing risk-related decisions that consider the applicability of the risk-free rate. In effect, greater detail is required to establish your transfer pricing analysis. Now, the implications for various cross-border debt structures, such as M&A, private equity, etc., involving intermediary holding companies, third-party debt pushdowns, and other such transactions are still being investigated. We don't have much to share at the moment, but we do expect to see further developments. Now, luckily enough, intercompany guarantees were also the beneficiaries of this new guidance. It's clear that companies must assess whether an intercompany guarantee is legally binding before considering the pricing of those guarantees. Again, we're seeing a reiteration of the completed transaction approach. The draft further refers to the yield approach and the expected loss approach for pricing these intercompany guarantees. Perhaps I should say, what is the actual benefit being received by both parties, and what is the yield for the corporate doing the lending, or in this case, the guarantee, and what is the credit risk attached to that guarantee? Now, with respect to cash pooling, examiners are now guided to carefully consider the functional risks of the cash pool leaders, the selection and application of the transfer pricing method, and the appropriate allocation of common benefit. Now, to many practitioners out there listening, this probably sounds like a common sense statement. Perhaps consider it a general warning that greater scrutiny at both high-level and detailed analysis is likely to occur going forward.
Interesting. So it certainly seems like there's a lot to consider for our listeners.
It definitely is for anybody impacted by the directive.
So I guess the obvious question is, when do these changes effective, and how are interested parties responding to these changes?
Well, the NTA is currently accepting commentary on the proposed changes. However, the expectation is that these changes should be finalized sometime in June or July of this year and effective for the fiscal year commencing on or after July 1 of this year as well.
Thanks, Stephen. Hey, so let's go to our first polling question of the day, which you can hopefully see on your screen. The question is, how impactful will the Commissioner's directive on the operation of transfer pricing be on your organization? And your options are, the organization will have a materially reconsider its transfer pricing, or the organization, number two would be the organization may have to reconsider transfer pricing on a few transactions, no impact at all, or don't know, not applicable. So while we're waiting for the response, Stephen, let me ask you real quick. You mentioned the OECD in your comments. Anything else you'd like to add regarding the OECD while we're waiting for the results?
Actually, there is, Scott. As I meant, the comment around the OECD was that the Commissioner's directive is OECD aligned, if you will, or congruous. While not a point of discussion in our limited time today, our listeners are well served to continue watching OECD developments regarding financial transactions globally, or in general. Japan's OECD-friendly approach will hopefully reduce the transfer pricing burden a bit. As companies are globally watching these developments, we might call regular country developments also just as noteworthy, for example, what we're talking about today. In this case, there's a bit of alignment that takes off the need for another local country approach that has to be reconciled with a global approach for the rest of the transfer pricing portfolio. Now, right now, what may be of interest is that other countries are looking to evaluate closeness or alignment or congruity with the OECD tax methods. We often see commentary about the U.S., but what may be more noteworthy for clients today is that Brazil, which operates in a significantly different system, is also contemplating changes to become more in alignment with the OECD. To us, one of the messages is that globally, countries are reevaluating how they're going to go. Multinational enterprises are probably going to be well served to continue or enhance their monitoring of global tax reform. It's taking on a greater significance than it might have in the past.
All right, thanks, Stephen. So let's see how the results are. So there's a few that's about 20% that have significant. Several transactions will have to be reconsidered. Other than the not applicable one, the biggest seems to be some transactions. Few transactions will have to be reconsidered, which is probably where we expected it. A few have no impacts at all, so that's good. Moving on, Stephen, let's turn to the topic that seems to come up in every conversation these days, COVID-19. But in this case, let's take it a little bit into how some of the tax exams in Japan have gone or been impacted by the COVID-19 environment. Maybe you can provide some insight on that.
Sure, Scott, I'd be happy to. So sort of in line with our examination topic, we expect examiners in general to be focused on probing and understanding intercompany financial transactions in much greater detail going forward. So with that, let's move to a few of the statistics and see what plays out. Now, as part of the global impact, the COVID-19 pandemic is credited, or should we say blamed, with impacting the tax controversy space here in Japan. According to the latest fiscal year 2021 statistics on tax audits, and as a reminder, the fiscal year is July 2020 through June 2021. Statistics are recently published by the NTA. The number of field audits of corporate taxpayers in fiscal year decreased by 67.3%. Very significant number compared to prior year. The total further amount of assessable income generated by those audits decreased by 32.3%, and the fiscal year collection, corporate tax imposed, or additional corporate tax imposed from those audits decreased by 26.6%.
That's interesting. So fewer audits, bigger numbers. Was there anything particularly that was a focus for these audits? Anything that kind of stood out to you?
So there are a few items that definitely stand out with regard to focus. But one of the most interesting facts was that while the number of field audits, found income, and total assessable tax decreased significantly, the amount of corporate tax per case went up dramatically by 124.3%. Definitely worth taking note of. The most significant numbers of the audits that generated that 124% focused really on three types of taxpayers: those seeking a refund of the consumption tax, those conducting cross-border transactions, which might be of significant note for our listeners today, and those that did not file corporate tax returns. So what we see really is that the tax authorities are focusing on cases where the taxpayer misconduct as suspected or tax amount stake was large. They were looking for the biggest bang for the buck, if you will, or yen.
Interesting. How about non-corporates? How were they? Was there any impact on the non-corporate audits?
Well, not exactly aligned, but we definitely see a similar impact. So with respect to the non-corporate taxpayers, the number of field audits decreased by 60%, so still significant. The total amount of assessable income generated by those audits was 47%, and the result of these decreases resulted in a total income tax imposed of decreased by 46.3% compared to the prior fiscal year.
Okay. Similar to my question on the corporates, was there anything of focus, anything specific that the auditors were looking at?
So again, what we found is the auditors focused on a couple of key significant areas. Now, real quick, before I list those three areas, I think I want to note that, again, while the number of audits assessable tax went down, the actual amount per case did go up. Now, in non-corporate environment, it was not as drastic as the corporates, but it's still tax per case went up 34.9%. So still noteworthy, even though not quite as dramatic. Now, with respect to where the auditors were focusing their time, again, three significant areas jumped out. Wealthy individuals, particularly those with foreign investments. And this is an interesting shift away from targeting the expatriate community to a broader and more applicable, if you will, audience for exam. Second, individuals that were conducting businesses over the internet also received an enhanced focus during this period. And then third, I don't think it would surprise anybody, those that did not file tax returns for the year in question. We can see again, the taxpayers were focusing where taxpayer misconduct or the amount at stake was significantly larger than other areas.
Okay, thanks, Stephen. So I guess the final question would be, where do we see things going? What does the exams look like in the near and immediate future? Any guesses?
Well, despite the decrease in audits for fiscal year 2021, the tax authorities have been actively conducting audits in the first part of fiscal 2022. So it appears that the audit world is getting back to normal. Now, it seems that this is expected to continue, barring a resurgence of COVID-19. We can't speak to what would happen if we had another resurgence here in Japan. Now, individuals may see an increase in new audits following the tax filing deadline, but we don't expect non-corporates to see any type of increase in audits until after really the return season is done.
Okay. Thanks, Stephen. Appreciate the insight that you provided. So now let's turn to some of the recent corporate changes in Japan. Hopefully, Mickey, let's bring you in, and maybe you could first talk about some of the financial services specific items, specifically the profit-linked director's compensation.
Yeah, Scott, before I begin, just since I'm calling in from a phone, just a sound check. Can you hear me all right?
Yes, we can.
Okay, great. Well, thanks, Scott. Okay, first of all, Japan hopes to draw more of the financial services practices onshore. This is kind of a historical trend as Japan is competing with, the other financial services, jurisdictions, like Singapore and Hong Kong. In support of this goal, the 2021 tax reform included changes to profit-linked directors' compensation. And the effective date for fiscal years beginning on or after April 1st, 2021 makes this change potentially relevant now. And our slide provides a brief summary of what is being addressed. So as a general rule, directors' compensation, including salaries, bonuses, and equity awards, is basically non-deductible unless an exception applies. And broadly, those exceptions include fixed compensation that's paid in equal installments, at least monthly, and then pre-notified salary and profit-linked compensation provided certain conditions are met. Profit-linked consumption and its underlying calculation method that are both disclosed in an annual securities report by a listed company is one of those exceptions. However, unlisted asset management corporations do not file an annual securities report and therefore could not previously apply this exception. The tax revisions create an opportunity for non-listed investment corporations that file blue form tax returns and qualify as special investment managers to gain access to this deduction. As one might suspect, the details matter.
Yeah, they always seem to matter, don't they, Mickey? So, real quick, just to clarify, it seems like these rules are somewhat limited, maybe just benefiting certain investment management companies. Is that correct?
That's right, Scott. In addition to meeting the detail requirements, we've also seen some reluctance to seek this exception because of the disclosure requirements. The investment managers would need to publicly disclose the objective criteria and calculation methods allowing the profit-linked compensation, and some non-public investment managers have been reluctant to make these public disclosures.
Okay, I know that this gets pretty detailed, these type of laws, but could you maybe take us through some of these things that you mentioned in a little more detail, at least some to the extent we can too on today's webcast?
Yeah, so let's take a look at the next slide to examine some of those details. So for purposes of the tax revision, a special investment manager is a corporation whose ratio of total profits from certain specialty permitted businesses to total profits for the current years is 75% or more. Currently, we are aware of about 4 classes of operations that appear to qualify under this definition. In addition, a qualifying special investment manager must ensure that the profit-linked remuneration must be limited to objective criteria based upon indicators of profit generated from investment transactions. The investment manager must also ensure that investor approval conditions are met through one of 2 mechanisms. The first mechanism being that fund contracts or asset management agreements must include provisions stating that the profit-linked compensation will be paid and the method of calculation. Or, prior to the fiscal year in which the performance-linked remuneration will occur, the existence and calculation of performance-linked remuneration is reported at a meeting of the special limited partners, and such report of the calculation is maintained in the minutes of such meeting, and there is no statement or record to the effect that an objection was made to by any of the partners or investors. For non-publicly traded investment managers willing to meet these requirements, these changes will hopefully create an opportunity for more and less complex directors' compensation, and hopefully presents a small step in leveling the playing field, but it is a welcome one. Back to you, Scott.
Thanks, Mickey. So let's move on to the next topic on the agenda, which is the treatment of carried interest. I know this is a hot topic in many countries. So maybe before you go into the detail rules, maybe set the scene as to level setting as to carried interest and what you really, in this context, what is meant for these rules.
Yeah, sure. So I'll make a few brief introductory comments about carried interest for those not familiar with the concept. The distinction for carried interest is based upon the difference between the tax rates applicable to salaries and service fees and the tax rates applicable to capital gains. As the bottom half of our slide shows, the marginal national tax rate rises to as high as 56% on salary and service fees. In comparison, the tax rate for capital gains is a flat 20%. The top half of our slide illustrates the distinction between partnership funds that are impacted and those that are not. So carried interest is a form of compensation paid by certain partnerships investing in or trading in equity securities. The illustration on the top right-hand side of our slide. Carried interest does not commonly arise in context of fixed income or real estate investment partnerships. Under traditional partnership taxation, allocations of income, items of income or loss are made in reference to the partner's capital contribution itself. And limited partner investment managers of these equity-based funds may receive an allocation allocate a return of partnership capital gains in excess of what they've actually contributed in the form of a capital contribution. Under prior law, a key criteria is that the carried interest not be reasonable, and reasonable had not been identified or clearly defined. Generally, limited partners who receive carried interest would need to have an investment in the limited partnership or skin in the game to claim capital gain treatment on carried interest. And the character of the income would need to be supported by the financial reports provided by the partnership. For example, limited partnerships that issued U.S.-style K-1s or similarly detailed statements of the types of character of income earned by partners help to support the capital gain treatment of carried interest. The new rules generally only apply to Japan-based investment limited partnerships and certain foreign partnerships that have registered with a Japanese financial securities agency. For example, because the limited partnership has investment managers or marketers solicit investments in Japan. In addition, limited partners in Japan who receive carried interest must include a separate disclosure of the carried interest on their Japanese individual income tax return. The new rule generally requires the distribution of carried interest is economically rational, and detailed statements reflecting the character of the income will continue to be needed to support the capital gain treatment. This isn't very different from prior industry practice, and therefore the new rules are generally considered to be a clarification of past industry practice. Move towards clarity is certainly welcome in an environment where errors can be costly. This clarification further supports Japan's attempts to become a center of financial services, center of excellence. So again, back to you, Scott.
Thanks, Mickey. Obviously, anytime we can get a little bit more certainty in tax rules, the better. We tend to sometimes be in uncertainty. So let's move on to the 2022 tax reform. Then I know we want to talk a little bit about taxation of dividend distributions. And in doing so, let's maybe take, again, the opportunity to provide a little bit of context and highlight some of the broader considerations for making distributions in Japan. So with that, Mickey, back to you.
Okay, thanks, Scott. We'll hold this discussion around two distributions, a domestic distribution, basically a distribution between two Japanese entities, and an outbound distribution, a distribution from a Japanese entity to a foreign parent entity. There are three important issues to consider when making a distribution, and those basically are, what are the distributable reserves of the distributing entity? And then the second question is, from what source is a distribution being made? And then third, what are the tax implications, both from a withholding tax perspective and a corporate income tax perspective? Distributable reserves are the maximum amount of funds a company can distribute and largely consist of retained earnings and what is referred to in Japan as other capital surplus, which is plus or minus some adjustments. So even if a company has excess cash, a distribution can only be made to the extent of the distributable reserve.
So real quick, so distributable reserve, is that a tax concept? Is that a tax calculation, or is it something based on book or other? How is the distributable reserves determined?
No, Scott, the determination of distributable reserves is provided under Japanese company law, not tax law. So this is more of a legal matter and would require legal counsel to advise on how to calculate distributable reserves precisely. From a tax perspective, the source of the distribution from retained earnings or other capital surplus is important, as the tax implications will vary depending on the source. A distribution out of retained earnings is basically treated as a dividend. A distribution out of other capital surplus may be treated as a deemed dividend, or it could also be partially a return of capital, which is a return of capital, which is treated as a deemed sale of shares, resulting in either a capital loss or a gain at the level of the shareholder. Withholding tax and corporate tax implications will vary depending on how the distribution is treated for tax purposes and whether it is a domestic distribution or an outbound distribution to, say, a foreign parent. And we'll take a closer look at those situations in the next slide. Just one other thing to point out is that Japan has a concept of a dividends received deduction for domestic dividend distributions that, and this DRD is what we call it, allows for a full or partial exemption of the dividend income recognized by the shareholder, the domestic shareholder, for corporate income tax purposes. So as you can see from the chart, that the amount of the exemption depends on the ownership percentage.
Okay, so before we go to the next slide, you mentioned that we could only distribute up to the amount of the distributable reserve. What happens if it's opposite is true? We have plenty of distributable reserve, but we just don't have enough cash on the balance sheet.
Well, that really depends on what the company wants to do. A company can just distribute what cash it has on hand. It can also make a distribution in kind, meaning distribute other properties such as a note receivable or shares in another entity. It can also declare a distribution up to the distributable reserve amount and simply owe its shareholder cash to be paid at a later date. Each of these alternatives will have a different tax implication in addition to what we'll talk about in the next few slides. For example, a company making a distribution in kind of appreciated property might trigger a capital gain that needs to be recognized and taxed. Well, let's take a closer look at the tax implications for a domestic distribution on the next slide. First, the withholding tax implications. Withholding tax of 20.42%, which is kind of a strange number, is 20% plus a 2.1% surtax, is imposed on domestic distributions to the extent the distribution is treated as a dividend or a deemed dividend. This withholding tax should really be considered a prepayment because the Japanese parent can claim this withholding tax against its corporate tax liability when it files a corporate tax return.
So, Mickey, if I understand this correctly, then at the end of the day, there'll be zero taxation, assuming the full dividend received deduction. But the parent company itself would not have that 20% roughly of the dividend to be able to pay onward until it actually files its corporate tax return. Is that correct?
Yeah, you're correct, and this can be a big cash flow issue for companies, especially companies who want to distribute a significant amount of funds out of lower-tier Japanese subsidiary all the way up to a foreign parent. This delay in getting a refund could impact the internal rate of return on a fund investment or reduce the cash to be available to service external debt, say on a leveraged buyout. Luckily, however, the 2022 tax reform changed this respect to companies that are entitled to 100% dividends received deduction. Basically, there will be no withholding tax on domestic dividends or deemed dividends on or after 1st of April 2023. Now, outbound distributions. If the distribution is made of retained earnings, the distribution will be treated as a dividend and subject to the same 20.42% withholding tax. But that withholding tax may be reduced or exempted under an applicable treaty, provided treaty forms are filed prior to distribution. There is no corporate tax on dividends received by the foreign parent, provided there is no PE, permanent establishment in Japan. So the withholding tax would represent a final tax imposed, if it's imposed.
Okay, Mickey, real quick. So you mentioned some treaty forms. Are those something that takes a lot of time to prepare?
Well, it can. The complexity of the treaty forms and the time required generally depend on the type of income, the actual ownership structure itself, and the particular treaty under which the benefits are being claimed. For example, if there are one or more intermediate pass-through entities between the withholding tax agent in Japan and the treaty beneficiary, the treaty forms will need to describe the entity and owners and may need to include support for the pass-through treatment. Treaties with the limitations on benefits article require a separate form specific to the LLB test under that treaty, and the LLB form also requires a certificate of residency to be attached to the form. In cases where the applicable tax treaty does not have an LOB article, attaching a certificate of residency is also helpful to substantiate the claim for treaty benefits because, the part of the test and the treaty are residency in the country. And so we see the best practices are to basically start work on the treaty application forms early, since treaty forms for relief at source need to be filed in advance of a payment subject to withholding tax. So it's important to start working on the treaty application forms early so that they're ready when they are needed to be filed. For example, if there are delays in obtaining a certificate of residency, like we see a lot of times in the U.S., apply early so that the certificate is available when the treaty application needs to be filed. Some ownership structures are complex and require additional information to fully document and sometimes even illustrate the basis for the treaty claim. So additional time and documentation may be needed to adequately support the treaty claim. Now, if the distribution was made out of other capital surplus, depending on the attributes of the distributed entity, the distribution may also be treated as a deemed dividend and part as a deemed sale of shares. The deemed dividend portion will be treated the same as a dividend, as discussed before, but the deemed sale of share portion, however, will be treated slightly differently. While no withholding tax is imposed on this portion, corporate tax is generally imposed in cases where the deemed sale share amount exceeds the tax book value the foreign parent holds in shares of the Japanese company, and a corporate tax return is technically required to be filed. However, capital gains may be exempted under some treaties, and treaty forms, again, may need to be filed depending on the specific treaty. Now, I'd like to go back to the distributable reserve discussion, as we often get asked whether there is anything a company can do to increase distributable reserves. And the answer, as usual, is it depends. And so what we've laid out here are two examples of how companies with certain attributes can increase distributable reserves. The first example relates to reducing the stated capital, kind of like a par value, or more like reallocation, a portion of this to this other capital surplus, which can be part of the distributable reserve. If a company has significant stated capital, it can undertake certain legal procedures to allocate some of the stated capital to other capital surplus, thereby expanding its distributable reserves.
Okay, well, that seems simple enough. Is there any downside or anything maybe companies should be aware of when they reduce their stated capital?
Whether there is a downside really depends, but you've got to look at everything. But there are certainly things to be aware of. For example, from a tax perspective, the reduction of stated capital to below 100 million Japanese yen may change the way the company is taxed from a local tax perspective, and often subjects the company to different regimes for certain incentives. Also, while I can't speak to all the details, I recall a company that wanted to reduce its stated capital, but in doing so, it would treat the company as a small and medium enterprise under certain company laws in Japan. And this would subject their customers and vendors to more strict rules when doing business with the company. In the end, the issues it would have caused in this client's business or in their business relationships was not worth the tax or distributable reserve benefits. The next example may be a way to include recent earnings into the distributable reserve calculation. Distributable reserve is generally determined based on the financials at the end of the year, so it's a whole year concept. So if, for example, a company had no distributable reserves at the end of year one, but had significant earnings and cash at the beginning of year two, for example, they sold a significant asset and wanted to distribute that cash. Well, those earnings would not be incorporated into the distributable reserve amount until the end of year two. So that cash could not be distributed until after that year has ended. However, a company can decide to close its book at any time during the year to solidify the earnings generated up to the closing of the books. So those earnings can be included in the distributable reserves, and the company can then make a distribution during the year based on the new distributable reserve amount.
Is there some type of formal process that the company needs to undertake to close its books in this case?
Yeah, Scott, there's legal processes that need to be completed, so Japanese legal counsel should be involved, but based on what we have seen, this involves doing all the things, all the normal procedures a company would undertake when it closes its books at year end, including creating financial statements and having them approved at an extraordinary shareholders meeting. Well, that covers everything we thought would be good to highlight around making distributions in Japan, Scott.
Okay, great. Thanks, Mickey. So that brings us to our next polling question of the day, which is, given the current economy, is your organization planning to repatriate profits outside of Japan? And your options are: the organization is actively seeking to repatriate products. So organization will repatriate products should it be appropriate to do so, not at all, or don't know, not applicable. So while we're waiting for these to come in, Mickey, real quickly, you'd mentioned earlier about the transitional rules for electronic record keeping. Briefly, could you let us kind of give us a quick summary of what that's about?
Sure, Scott. I'll try and keep it short. The 2021 tax reforms eased the requirements to adopt electronic record keeping, and as part of those new rules that came into effect on January 1st, electronically transmitted or received documents would need to be kept in electronic form and in conformity with the new rules, or penalties could apply. So maintaining hard copies of documents transmitted electronically, which was the default rule, and maintaining hard copies, which was kind of like the default rule, and common practice in Japan would not be permissible without the risk of penalties. And so the transition rules pushed back this particular requirement by 2 years. So companies that have not been able to make the necessary changes to their systems or are not finalized their workflows to accommodate the new rules have until December 2023 to make changes. The tax source has some additional information on the new rules and the transition measures.
Okay, great. Thanks. So looks like we have the results back. So looks like the biggest percentage is the organization will repatriate products should it become appropriate or need to do so arises. Any comments on that, Mickey, before we move on to Korea?
Just as mentioned, if you're seeking treaty benefits, then try and get an early start. The other issue could be trapped cash. That could be a common issue, especially for investment, assets. Cash may be generated from non-cash deductions like depreciation, but the depreciation deduction results in less retained earnings. So people may need to consider whether it's possible to reallocate, stated capital to other capital surplus to allow for a distribution of this kind of trapped cash.
Okay. Thanks, Mickey. Appreciate it. So let's move on to South Korea. As you probably noted, the lion's share of the time was dedicated to Japan as there were significant changes there. Unlike the significant developments we were just discussing in Japan, Korea only has some limited number of changes which impact our financial services industry clients here in Korea. The first item I'd like to discuss is a change. Actually, it's a change to the individual income tax related to investment products. At first glance, you may ask, why would we bring up an individual tax development? But as we'll see in a second, it does impact our FSI clients. Previously, individuals were generally not taxed on gains from the sale of listed securities or bonds. But with the recent tax revision, such income will generally be taxable from January 1st, 2023 as a separate bucket called financial income. And that will be taxed at a rate of 22% for annual gains up to 300 million Korean won, roughly 240,000 USD, and at a rate of 27.5% for any excess beyond that amount. The reason this matters for our corporate financial service industry clients is that this income, it will be subject to withholding tax. at source, and the withholding tax agent generally are financial institutions, brokers, etc. Again, they were required to do the withholding at 20% and submit this and file tax returns with the tax authority on a semi-annual basis. So this represents a change, also represents a risk, as failure to withhold taxes can shift the burden from the individual to the withholding tax agent, along with potential penalties for not doing the withholding appropriately. This is obviously, as I mentioned, a significant change to financial institutions, as it will impact their systems. Obviously, systems were set up with this tax one way originally, so there will need to be some modifications made to systems, as well as testing to be done before the new law becomes into effect. Furthermore, the investor has more than one financial account subject to these rules. There will be a need to coordinate with the basic deduction can only be selected on one of the accounts. So as you can imagine, the new taxation regime will require that financial institutions provide data to the tax authorities, including withholding tax receipt, but also detail around payments, transactional detail on each product, details of the holders, investors, and so on. So a lot of data that the tax authorities has not previously been privy to. And if not duly reported, it would be subject to, again, a different penalty for failure to provide this information. So in the long or middle run, I guess the Korean tax authorities has indicated they have a plan to make an integrated system that would connect the withholding tax and reporting requirements implemented by each of the financial institutions. But as you can imagine, it's a little bit of concern, particularly to our wealthy clients here in Korea, as the tax authority will now have access to more information than they had before, and resulting in the potential for additional tax scrutiny, not only on the income tax side, but especially on the inheritance and gift tax side, as accounts and as assets are moved on to the next generation. So something to take into consideration. Moving on, I want to also provide a couple other updates. So Korea, as you can see on the current slide, has beginning next year again, will tax cryptocurrencies. To facilitate these changes, the Korean government has indicated that they will establish a new division to supervise the crypto assets. And the tax authority, as expected, also announced that they will create a new division and have announced a list of qualifying crypto asset service providers that will be used in determining fair market value of crypto assets, again, for inheritance and gift tax purposes. The second change that I wanted to highlight, again, that it impacts all taxpayers, but a lot of our large financial companies, is a change to the Korean undistributed earnings tax. So Korea, like some countries, to encourage large corporations to make additional either capex or increases in salaries, the corporate taxpayer is required to pay an additional corporate income tax on the undistributed earnings, or carry forward a reserve to the following year, and then use it in that following year. Based on the amended tax reform bill, that reserve carry forward period has been extended from 1 year to 2 years. This is primarily due to the COVID-19 crisis. So essentially, companies that would otherwise have to pay this excess undistributed earnings tax will now have an additional year to invest those funds and that reserve either into capex, additional salaries, or other qualified investments. Again, this was made because of the COVID-19 crisis, but it is a permanent change to the tax law, so it will continue to apply going forward. Even after the COVID-19 crisis subsides. So that's actually a good benefit for our taxpayers here in Korea. Finally, wanted to provide a quick update on the current tax controversy, tax atmosphere here in Korea. Unlike our friends in Japan, the Korean tax authorities did not take it on themselves to reduce the amount of audits. There was no noticeable. I don't think I've seen public numbers yet, but based on our experience and our knowledge, there's really not been a reduction in tax audits. The Korean tax authorities have continued to perform aggressive tax audits in Korea as they have in the past years. And there was minor adjustments, number of days spent working the client office, the taxpayer offices, things like that, because of COVID, but no change in the number of audits or honestly, the aggressiveness of the audits. In fact, the Korean Tax Authority in February announced that they had conducted tax audits of 44 offshore tax evasion suspects, which they believe took advantage of some overseas entities for purposes of reducing their Korean taxes is unwarranted. So based on what they issued, they kind of bucketed it into a couple different cases. I'll just go through it real quick. The first one was tax avoidance through overseas subsidiaries on domestic companies. So this is where a majority shareholder of a domestic company establishes an overseas subsidiary in the name of like an employee, and then through related party transactions, whether it's service fees, loans, whatever, between the Korean headquarters and the subsidiary, managed to move some of its revenue and income to an offshore subsidiary. The second one they indicated was tax avoidance through a permanent establishment of a multinational company in Korea. And this is actually where we've seen a lot. There's been quite a few audits that we've been involved with, tax defense, where either there's more substantive things taking place in Korea than what what the policy would say. So there's really a person in Korea is really substantially controlling and managing the business in Korea, yet it's either a non-registered presence or a registered liaison office, which is not taxable. So we see that. Another case was where companies would bifurcate their agreements between the overseas affiliate and Korean sub, and essentially make it look like there was less activities performed in Korea than there really was, by either doing one or two subsidiaries or bifurcating contracts. And in the case number 4, as you can see here, is actually a similar type case, but where there's long-term contracts. Generally, a long-term contract over 6 months would create a PE in Korea, and they identified companies that would create break up service agreements into separate components. For example, the design phase or the installation phase or the supervision phase or the after, which would normally be one contract but broken into separate contracts to try to avoid a Korean permanent establishment. So they've identified some taxpayers that took advantage of that. And then finally, while not applicable, most multinationals, some unfair tax positions taken with regards to overseas subsidiaries. So as you can see, they continued to, and they made the unusual, case of actually publicly noting some of these in Korea. So tax authorities continue to aggressively audit foreign multinational companies in Korea, as they are obviously looking to maintain or increase revenue levels here in Korea. Again, it should be noted, as I just indicated in our introduction, that as of today, just a few hours ago, there is a new President Yoon in Korea. While, again, he's expected to be more business-friendly and has indicated a willingness or a desire to see some changes to the tax rules and tax regime, it's still unclear whether or what significant changes might take place and how soon. Again, we'll have to wait until after the National Assembly elections here in a couple weeks. But we do expect changes. How significant they will be, we'll have to wait to see. So, again, as you can see, Korea not quite as significant as changes as Japan, but maybe with the new regime next year we'll take more time and let our Japanese friends have less time. So, anyway, thank you very much, Stephen, Mickey, for your participation today. Thank you for everybody for joining. Let's look and see if we had. It looks like we do have a few questions that have come in. We may not have time for all of them, so let's quickly go through one of them. So one question looks like, let's look, it's more like it's a Mickey question. So what is the tax incentive for wage increases mentioned in the introduction?
Yeah, Scott. So each year, Japan introduces a tax credit on annual wage increases, and the total credit that's been offered under the 2022 tax reform is 20% of a corporation's tax liability. And the calculation method is a little bit complex. And so we recommend looking at some of the tax newsletters that we've provided on this console. You can download that and look at it. But basically, the new rules applies for fiscal years beginning on or after April 1st, 2022. And through fiscal years that begin by March 31st, 2024. And so, again, it's a little bit difficult, but for large corporations, up to 30% of the total increase in wages can qualify for the credit. For companies that are treated as small or medium enterprises, up to 40% of the total wage increase can qualify for the credit. And the percentage of increase depends on the percentage of the credit amount depends on the amount of the salary increase. So for example, a large corporation, if they increase their wages by 103% compared to the prior year, allows them to allocate 15% of this wage increase to the credit. If that wage increase year on year is 104% of the prior year, then you get another 5%. It increases to 25%, so another 10%. And then if training costs have increased 120% from the prior year, then another 5% of the wage increase gets added. And so if you hit the 104% and of salary increase and the training cost increase of 20%, the 25 and 5% gets you 30. And there's similar rules for small and medium enterprise, and that credit can get up to 40%. And I think we're running out of time, so I don't want to go through all the details, but basically the measurements are a little bit not as hard. Instead of 103%, it's 101.5% to get those smaller amounts, and 10% for the trading costs. But you can get up to 40% of those wage increases to count towards that credit.
Okay. Thanks, Mickey. So there's a few more questions. Let's take one more. There's a couple that are a little bit more company-specific or circumstance-specific, and we'll respond to those directly. With one more, asking a little bit more information around the transitional rules for electronic record keeping. I know we talked about it briefly before. Is there anything to add there, Mickey or Stephen, that you might want to add to that? Or should we cover it pretty much? I know it gets detailed.
Yeah, I mean, it's a welcome, transitional rule, and the way I see this particular transition and on this rule, that Japan has historically had a very paper-based requirement, and the rules to actually get into the electronic record retention law requirements were really steep. So Japan adopted these rules to kind of ease people to get into this. But this particular one with penalties, it applies whether you're adopting them or not. And so it's Japan's way to kind of force companies into keeping their electronic their records electronically. And so maybe the government decided, that we need to give people more time, a couple more years, before forcing people to get rid of all these paper documents. So I hope to see more companies adopt electronic records, that's all I would have to say about that.
Thanks, Mickey. That is beneficial to our taxpayers. Obviously, anytime you make changes and starting to have electronic or digital repositories, it never quite goes as quicker as well as you would like. So, so it's good that they provided such rules. So, unfortunately, everybody, that's all the time we have for today. Again, Stephen, Mickey, thank you very much for joining us and presenting. Special thanks to all those who participated. We thank you very much for joining with us. We would like to encourage you to fill out the short survey that will pop up on your screen momentarily and tell us what you thought about today's program. If by chance you joined us late, please note that the presentation will be archived for future viewing. And if you feel inclined, feel free to share this with others via the share this icon, or have them visit the debrief website. Again, we did have a few other questions come in, so we'll respond to those questions submitted directly during the next week or so. Also, if you can think of any other questions or comments or anything else that we can help you with, feel free to reach out to myself or any of the speakers directly. Be more than happy to talk to you and help you with your needs. Again, thank you for joining, and please note that our next financial services debrief series webcast will be on May 17th, 1 week from today, and it's titled Financial Services Series, Tax Developments in India. So as we all know, lots of changes in India annually, so please feel free to join in with us on that. And again, one more time from us at Deloitte, thank you for your participation, and we hope that you have a great day. Goodbye.